This is not easy. It's not a silver bullet to fundraising, but when done correctly with the appropriate expectations that are set and issuers understand what it takes from a thought leadership perspective, from a content creation perspective, from a paid advertising perspective, we've seen this work incredibly well and allow companies to be very successful, raising tens of millions in capital.
Hello, everyone, and welcome to another episode of Test, Optimize, and Scale. We have StartEngine on the pod today. Harrison Bert, Director of Fundraising. If you are not familiar with StartEngine, they're one of the top, if not the top, FINRA-regulated portals. They literally host the top Reg CF, Regulation Crowdfund, and Reg A+ deals, and everything passes through Harrison's desk. We're going to be able to speak about issuers, the contrasts of the approaches that make these founders successful, industry leading again at that, and have more marginal campaigns. We'll be able to talk about how the most proactive founders have the most successful campaigns, as well as investors and the StartEngine owners and what they are looking for here in 2024. Harrison, thanks for taking the time to be on the podcast.
Of course. Thanks for having me on, Jason. Looking forward to speaking.
We talk about StartEngine on the show so much that to have you here as part of the discussion is truly a treat. And want to start the discussion with your background. What brought you to this world of regulated investment crowdfunding? Where did it all begin for you?
Sure. I actually started on a very different end of the spectrum when you look at the financial world. So I studied finance in college and then actually went to do investment banking at JP Morgan for several years before even hearing of equity crowdfunding. And I think as I progressed through my career on the debt capital market side, so helping very large private companies, sort of mid-cap size public companies raise capital for general corporate purposes, LBOs, mergers and acquisitions, I learned about equity crowdfunding somewhat circumstantially, actually seeing, I think, an article that Kingscrowd put out just talking about data on the industry, and had never heard of it before, but had always been interested in the private investing side of things and alternative investing, a very different world than I was coming from with traditional investment banking. And the more I learned about equity crowdfunding and did my research, spoke to members of the StartEngine team, spoke to our founder, Howard, really got interested at this sort of two-sided approach where not only are you helping founders from a democratization and a capital raising perspective, but also helping investors from the direction of something I was really passionate about, which is opening access to this sort of area of investing that's created an immense amount of wealth for people over the last 4 decades, but 90+% of the population has been precluded from purely from a net worth or an accreditation standpoint. So it was really compelling to me to help founders where VC funding and traditional capital raising is so difficult, but also this open approach that it took from an investor standpoint.
The democratization of early stage private equity, right? Valuation. I've seen numbers on Kingscrowd these days of 13 million for early stage issuers, organizations offering shares through these vehicles, 39 million, taking into account growth stage as well too. So if those organizations grow, perhaps they hit hundreds of millions, billions, tens of billions. The potential upside could be substantial, and like you said, only a small percentage of Americans, of investors are able to have access to these deals, and that's what makes these filings so powerful. And I, talk to founders every day. I know you're on the line with them, probably your offices, all day long, speaking about the access to investors and not just going through relationships, being able to solicit to both retail and accredited investors to bring them into the round. Really, a win, a major step forward on all sides of the table.
Absolutely. And I think I came into the industry at an interesting time at the beginning of 2021, where, as you guys saw on the marketing side, there was incredible success I think issuers saw running paid advertising. And we were also right in a zero interest rate policy environment. So capital was very freely flowing. So an interesting trend I think we've seen the last 3 years, entering this industry at a time where companies were raising from VCs, investors were putting a ton of money into equity crowdfunding. That was the highest year from a capital commitment perspective we had since this industry's inception back in 2015, 2016, as CF and A plus were written into securities law. And I think there's been a really interesting maturation of the industry these last 3 years as targeting from a marketing perspective has become more difficult, but also a sort of tighter view on capital allocation in a rising rate environment and inflationary environment. While in the broader economic sort of playing field, we've seen a decrease in capital commitments, especially from VCs. And you and I know, speaking to founders, raising has become incredibly difficult, especially at that seed, C plus, Series A stage. Interestingly, the equity crowdfunding space, I think, has stayed somewhat insulated from those broader trends where, again, from a total capital commitment perspective, we're maybe down 10, 15% from 2020, 21 highs, versus in the VC world, we're seeing funds flows down 30, 40, 50% for these founders. So I think it's been this really sort of juxtaposed dynamic of a more difficult marketing environment for companies, but also a broadly more difficult fundraising environment that's led to an influx of quality, I would say, into the Reg CF space, where we look at data that Kingscrowd and some other providers put out, and the average age of a crowdfunding issuer has increased significantly. The average revenue of a crowdfunding issuer is now, I think, over $300,000 a year, where 5 years ago, the average crowdfunding issuer was pre-revenue. So I think we're seeing a nice trend from a quality and stage perspective, and it's going to be cool to see how that plays out over the coming years. Is hopefully we see a bit more optimism around investment and capital deployment and the broader macro environment.
Very well said. I couldn't agree with you more there. And I like the contrast you made of the more traditional private equity markets, what we're seeing in regulated investment crowdfunding, the CFPA, the Crowdfunding Professionals Association Board, they've really imprinted in my brain. Regulated investment crowdfunding versus equity crowdfunding, incorporating debt, and speaking to the regulated aspect of it. I've seen those same numbers where it's showing where the space was in 21, 22, 23. 22, 23, the Reg CF, they were both around 422 million per year. So like you said, pretty steady. It's going to be interesting to see what it's going to add up to here in 2024. I think there's a strength in numbers aspect of how many investors have entered the space, and user owners, even, in some cases, local businesses that are issuers and bringing in patrons, bringing in customers to become a shareholder into the entity, and how there's new investors entering the space every day. Talking about quality as well too, really wanted to emphasize the strides that StartEngine has made, and to lead the industry at that, to bring in quality, and that influx being a result of that. I know your terms, your rules, and how you accept issuers has made leaps and bounds over the past few years. Not to say it was off at any point, but in efforts to bring in the best quality for investors on StartEngine.
It's a good point, Jason. And I think part of this probably broader industry shift you've seen towards, again, later stage, you could call it higher quality issuers in general, is a bit of a reaction to sort of investor preferences and where they're trending and what investors are responding well to on these platforms. As over the last 2 years, we've had companies that maybe raised VC capital in 2019, 2020, and they're looking to continue to grow. They want to raise inside rounds, but their existing investors or their syndicate of VC funds has dried up and they weren't deploying capital the last 2 years. We've seen those, again, later stage, well-funded companies look to use equity crowdfunding. And I think that has created overall better opportunities for investors. So now they can be a little more selective in terms of who they put their capital towards.
And founders have shared with me in general advantages of going down this road versus what they experience in the VC space. So I'm just on the marketing side, looking to target investors, bring them down marketing funnels, but they'll point out some of what those discussions look like, and question marks around valuation, control being a common aspect there, where with Reg CF, the valuation being set, having investors structured to be on one line, the cap table, that there are many, benefits to using this. For me, on top of marketing, the amount of impressions, the amount of clicks, the amount of traffic, when I'm saying clicks, that come out of one of these promotions, and the awareness that follows, the ability to bring on ambassadors and have thousands of investors complete a round, with the percentage of those individuals then sharing on social media, sharing to their first degree networks, future milestones that the business hits, and not just the raise itself. Some of them become super users. I've seen merger and acquisition activity. I've seen franchise partnerships. I've seen all types of great things come out of the new investor audiences that come into the rounds. So I've seen that pointed out as well too, on why higher quality organizations are starting to use these filings.
There are two good points you made there that I maybe want to focus in on.
Sure.
One being this comparison between VC funding and equity crowdfunding. And I think a lot of times it's positioned as what you need to go down one path to the other, and going down one precludes you from using a different type of fundraising in future rounds, which I don't necessarily think is true. While VCs have gotten, I think, generally a bad rap the last few years with terms that may be predatory to founders, and if you're not careful about how you negotiate liquidation preferences or pro rata rights with VCs, these founders who have built their businesses over 10 years plus may not actually make much or anything upon an exit, given what kind of right terms you've negotiated with a VC that takes preferred equity. Now, I think on the other hand, VCs have created an incredible industry that did not exist 40 to 50 years ago, and startup companies had to go to banks and get debt financing to grow. So it's been a really beneficial space, I think, overall, incentivizing a startup culture and an entrepreneurial ecosystem within the United States, especially. But it has become this very selective form of raising capital, where a very small percent of founders end up raising from VCs. And that very small percentage that does tend to be white males who went to an Ivy League school or a tier 1 or tier 2 university, and a lot of other founders that don't come from those more sort of privileged backgrounds, I think, have had difficulty raising capital. Now, with that being said, there's benefit, I think, in using both, and they can be used in tandem, where we speak to a lot of companies who are working on closing a venture round and then want to allocate a piece of their broader raise to an investment crowdfunding model for a lot of the reasons you stated. There's brand awareness benefits that come from this. Your customer acquisition costs can go down. The lifetime value of these super users or brand ambassadors who now own a small piece of equity in the company are now financially incentivized, right, to help you grow and help you grow your business and grow your brand. And you're never going to get those kind of ancillary benefits from a private raise through a VC. So I think for a lot of startups out there thinking about raising capital, it doesn't need to be, I'm either going down the VC route or the investment crowdfunding route. There can be a combination of both, and at different stages of your growth cycle as a business, different fundraising strategies can make more sense than others.
Yes. And it's good that you pointed that out, because we're talking about the differences in each vertical and over the past few years. And you're right. I don't want to make it sound like an either or. We work with VCs, we have partnerships, and speaking with the heads of various investment banks at different conferences. So I don't believe competitive nature between the two is the right way to point it out. And like you said, it can be allocations of the same round. It could be different progressive steps. So I think that's a great thing to really highlight to audiences here, because it does get brought up in panels and at conferences, and hey, this is better, that's better, when really they're just tools that can be used towards an organization's overall growth, which is what I think we're all playing for. That being said, investors, individual, retail, angel, VC, What are they looking for here in 2024 from your perspective? You guys have an excellent ecosystem and the ability to look at, closed loop conversations in the sense of not just speculation from an issuer of what does the audience think of my offering page, but what are they physically telling StartEngine, and
Yeah.
therefore, how should the audience shift based on that appetite today?
It's a really good question. I think the last 3, 4 years, we've consistently seen an increasing breadth of types of industries and verticals that can leverage equity crowdfunding successfully. Where when I joined the industry in 2021, most of the successful raises we had seen to date had been what I'll call, very broadly speaking and generalizing, direct to consumer companies, consumer packaged goods, right? Some kind of consumer facing brand or platform where they had an existing community to bring to the table. And there were very intuitive, easy to understand benefits of using a crowdfunding model where your customers, your fans, your users can become investors, as you and I have both mentioned. And maybe they become future franchising partners down the road. Maybe they're just super users. Maybe they get some kind of product perk by nature of investing. I think the last probably 2 years, especially, we've seen an increase in the success of, broadly speaking, call it less consumer facing B2B companies that are very tech focused in their approach. They are operating in an industry that requires intellectual property, differentiated types of technologies, R&D heavy industries, capital intensive industries, but the end result of the solution they are working on solves a very big problem. Maybe that problem is in the healthcare space. We've seen more drug discovery companies now use investment crowdfunding successfully. We've seen clean technology companies use investment crowdfunding successfully. So I think there's been a bit of a shift from an investor side where they say, I don't only get excited about companies that I already know as a customer. I'm not only excited about investing in the brewery that's around the corner from me. There are 5 other companies that are working on new patented wind turbine technology, for example, or there's a company working on a treatment for cystic fibrosis. And me as a retail investor would never even dream of having an opportunity to invest in this, albeit highly risky startup at an early stage in its life cycle, but now I have that opportunity. So we're seeing this sort of general trend of almost 2 broad buckets of issuers, where crowdfunding to me will always make intuitive sense for those consumer facing brands, products, service businesses that can raise from their communities and see additional benefits above and beyond that, and network effects that come from doing so. But companies that historically would only think about raising capital from angel investors or strategics or VCs, they're now seeing comparable peers in their industries, in their verticals, raised through investment crowdfunding for different reasons, but being able to raise successfully.
And when you see that success, I imagine it follows with issuers, potential prospective issuers in the same vertical. As you said, those comparable peers. Is that the case where you'll see a clean tech company do well, and the next month there's a half dozen, a dozen other potential issuers from that space?
But we do see it that way. I think, interestingly enough, all it takes is one. It
Hmm.
takes one sort of surprise successful issuer, if you will, in an industry or vertical we may not have tested in the past. And it takes one success story to be able to ask ourselves, maybe we can replicate this for another company in the same
Sure.
industry. For example, drug discovery companies, I don't think we had raised for more than 2 or 3 prior to 2022, and then had a very outsized successful raise for a drug discovery company. Now we've been able to replicate that for several issuers subsequently.
And do you see, and if you can't share some of this information, please don't feel any pressure, but do you see some of the same investors participating in multiple rounds, multiple players in the same space?
We do. I think we're seeing more commonly, and this is very anecdotal without speaking to specific data points, but more
Sure.
commonly, investors tend to be focused on specific industries and investing in multiple companies in those industries as opposed to diversifying across industries.
That's very interesting. And you think of the common traditional portfolio model, maybe 10%. what have you, high risk, high return. Perhaps that's in private equity and diversification within that. Is there Are there a lot of resources for investors to speak about, how many deals they should be participating in and diversification across different industries? Do you see different approaches, different strategies come from the investors when you get to speak with them firsthand? StartEngine owners, perhaps?
Investor education is a part of our industry that I've always been really passionate about. And I think every platform out there, every news source out there covering investment crowdfunding, StartEngine included, has fallen short in terms of what we need to do
Hmm.
from an investor education standpoint. There's a lot of room, I think, to grow in terms of the resources platforms are providing to investors, talking about what a typical diversified portfolio looks like. Or when you step back and, I think, from an investor perspective, just take a 30,000 foot view at investment crowdfunding, it should be a very similar strategy that VCs use, where maybe it's 10, 15, 20% of your portfolio that ends up leading to a positive exit. And those other 8 swings you took are likely misses or don't generate a positive return for the fund. And retail investors should be viewing these types of investments the same way, where I think industry wide, we're seeing the average number of investments per investor is quite low. It's definitely not in the 7, 8, 9, 10 range. It's probably more on the 1, 2, or 3 investments per investor range. And the people who sort of begin that discussion and start to create that trend shift, I think it has to come from the platforms. It has to come from the King's crowds of the world. It has to come from the CFPAs of the world, these industry insiders and experts who have ways to sort of nudge investors and give them more resources so they can make that determination for themselves. I shouldn't only be investing in this one company, this one brand I already have an affinity for. It should be this plus 5 others.
Yes. And I believe investor success stories, that is going to be the driver.
Mm,
Those individual experiences will get the spotlight on the vertical. And on the flip side, investors having too many losses, it could, have steps in the opposite direction for us. As a space, as an industry, as a vertical. So I think that's a great thing to point out. I am a fan of the StartEngine, owner program, and how that does make it easier for individuals to participate into multiple rounds, multiple organizations. There's incentives involved. I imagine there's a compliance aspect, even around the educational pieces. But I think it's such a great area to focus on for those reasons.
absolutely. And we like to say at StartEngine, you mentioned our owners program, which we've since rebranded to Venture Club, that we
Venture
eat our
Club.
own dog food, where we've actually never taken in traditional institutional capital. We've raised, I think, over $60 million for ourselves now across multiple Reg CF and Reg A plus raises. And I think we've tried to be a leader in the industry in that sense where, hey, we know this model works because we've used it for ourselves successfully. And there's, for us, in a very unique way, anyone who invests directly in StartEngine has a pretty good reason to invest in other companies we raise for. So there's a very direct and easily to understand benefit of allowing our customers, our users from the investor side to become investors in StartEngine itself.
And it's a standout in the industry. And like you said, you're taking your own medicine. You're using these tools towards your own growth, towards your own success, allowing audiences to participate there. It's something I speak about regularly, and not just saying nice things about it because we're on a podcast here together. What have been the top drivers to make the StartEngine campaign successful? We could go beyond that with this question of what have the largest issuers on StartEngine done to position their rounds to raise more than other groups in the space. And part of the reason that I asked this question speaks to the analytics that I see on King's Crowd.
Mm.
It's Monday morning. I'm going to do my Monday report later today, looking at the top campaigns of the past week. And StartEngine as a platform, I look at the average raise per issuer on a platform has larger amounts raised than top competitors. It's a higher average per investor. StartEngine is regularly on the top charts, and in Reg CF as a whole, I'll look at the top 10% of issuers and define them as moving, and the bottom 50% as stagnant. Can go over the stats specifically for how much those campaigns raise. I believe there's some misconceptions in this space, but what I choose to focus on is how do you become one of those top 10% issuers? What does make a fundraise successful online?
I think there are almost an ethos with which you approach fundraising that both StartEngine as well as our most successful issuers use, and I don't think anywhere near enough issuers use. And that's the idea of always be raising capital when you can. And very integrally tied to that is the concept of transparency to investors. And we are big believers ourselves at StartEngine in we want to communicate with our investor base constantly, both our highlights as well as our low points. And that level of transparency, hosting annual investor webinars, hosting quarterly Q&A sessions where people are asking us very direct and difficult questions around where has the growth been as this broader industry has been relatively flat and slow over the last several years. But by not only calling attention to both our successes as well as our failures, we've been able to go back to these investors again and again and raise additional capital and grow our brand and try to position ourselves as an example in the industry for how other issuers should be approaching this, where again, this is not a silver bullet to raising capital. Equity crowdfunding can and should be used as a complement, I think, to other forms of capital raising where appropriate. But if you do want to truly commit to this model and come back to the crowd for multiple Reg CF raises, and then as you grow as a company, expand into Regulation A+, which now allows companies to raise up to $75 million every 12 months, as you know, it requires a real commitment to investor communication and transparency with investors. So even if the story has not been all bells and whistles and all good things since your previous rounds, investors appreciate that you've been so communicative, and they appreciate that you're talking about your missteps, and you can use that to tell a story for why are we raising this additional capital, why are we coming back again, and why can you have confidence in investing in us again. And I think we see in the data as well, some of the most successful raises and successful crowdfunding issuers are ones who come back to the well repeatedly and keep raising capital. And the biggest thing in my view that allows them to do that is the constant communication and transparency they have with their investors.
Investor communication and transparency, constant, always be raising, which we've quoted Howard Marks on many times for years now. Whether you're looking at highlights, whether you're looking at low points, being able to speak to the audiences in that regard. And it sounds self-explanatory. I can tell you, I speak with issuers every day that are looking at their second, their third, working with some groups on their fourth round, which just completed the sixth round with one issuer. And that is not always the case. More times than not, that there are missed opportunities for webinars, those quarterly reports, town halls, bringing in the Q&As. We'll get contacted by issuers that we worked with years back, and they're no longer raising on a FINRA-regulated portal, but at the same time, they're getting questions from investors, and it can really become a problem if those communications are not taking place. I have heard concerns on whether the audience will respond positively if there are low points occurring. But like you said, through that transparency, stronger relationships emerge. Through that transparency, you're able to demonstrate to the whole community how this should be done, and it's been able to show positive results firsthand to anyone who's watching.
Absolutely. And above and beyond building a foundation to set you up for future capital raising, especially for these consumer facing companies we've talked about, there should be a very clear incentive to keep your investors, keep your customers, keep your users informed of how the business is doing. And I think whether it's a monthly update, a quarterly update you send out to investors, every one of those communications should be viewed as an opportunity as a company, as a founder, to say, I should be asking my network of investors how they can help me. Do they have people they think I should speak to? Do they have potential partners, potential customers I should be speaking to? Do they know this industry somehow? And I think the odds are, if you have 500 to 1,000 people on your cap table, there's probably a handful of people there who can deliver really tangible, positive value to your business. And not taking advantage of that leads, I think, most issuers out there at the moment who have used crowdfunding or plan to use it, you're missing out on a huge part of the value of these exemptions and this way of raising capital.
Yes. You guys see it all firsthand and, are able to point to that as a missing in the space. And like you said, it's part of why these exemptions were created. Want to ask you a question before we start getting into the test optimization recommendations. I think I'd say the title of the show enough not to trip on the word there, but have to ask, as I've had other StartEngine leaders, team members on the show, and you guys have famously acquired Seed Invest since then and brought
Correct.
in new investor audiences. How has that impacted campaigns here in 2024? Have you seen contrasts, overlaps from the audiences, from the investors that were participating on deals on Seed Invest, one of your large competitors from years back? And have they shown up for the StartEngine campaigns here this year?
Sure. It's a good question. The big value we're seeing from the Seed Invest acquisition, now that we're over a year past it and past integrating their database and their raise history into ours, is the growth of accredited investors in the StartEngine investor network.
Very nice.
So prior to the Seed Invest acquisition, the vast majority of our investor lists that we marketed deals to and that were interacting with the StartEngine platform on a daily basis were non-accredited, maybe investing a $1,200 average check size. Whereas Seed Invest, the average investment per investor was significantly higher, and a substantial number of their investors were actually accredited. So I think sort of diversifying, if you will, the mix of the investors that we're putting offerings in front of that we're able to market to is the biggest value that we've seen very tangibly come out of that acquisition.
Had to ask. Somewhat what I expected, and it's showing again higher average amount, raised, higher average transactional value from what we've seen. And I get questioned by founders regularly: is it the same? Are they the same investors participating on each platform? Does one portal have a different follower base than the other? Glad to hear about larger, high net worth, high household income audiences that are now on the StartEngine platform. And whether we're talking about retail, whether we're talking about accredited, what do you recommend for listeners who are founders, perhaps marketers, or even an industry professional working on a Reg CF, working on a Regulation A+ campaign right now to test towards their own round? And I say test, it could be a marketing test, anything positioned towards growth, right? And it's a series of tests, being able to find what works. We see, one campaign perform differently than another. You mentioned advertising, especially meta advertising, Facebook, Instagram, not necessarily as impactful as it was back in 2021. I say necessarily because the consistency aspect has certainly changed. But what I still believe, you need traffic sources, perhaps 50,000 visitors per $1.2 million raised, reflecting that $1,200 average that you're speaking to. And again, I know it's higher with the accredited investors averaged in there, but if you're seeing a 2% conversion rate, 50,000 visitors, 1,000 investments, maybe it's higher, maybe it's 3%, 5%, over 10, but I would rather position founders to project conservatively and be surprised if the conversion rate's higher, but tremendous amount of traffic, relatively speaking, to produce the necessary amount of conversions to substantiate the round and close, at the full cap. What tests would you encourage audiences to take towards their own fundraising campaign?
Test is a very appropriate word. And the first piece I would mention is, I think not only every company considering investment crowdfunding, but every startup even thinking about fundraising through whatever avenue should do some level of a testing the waters campaign, which, as you know, is now allowed under regulation crowdfunding, where prior to doing any work with a platform, to filing anything with the SEC, companies are allowed to go out and say, we are thinking about opening up investment to our community. We're thinking about pursuing a crowdfunding campaign. With appropriate disclaimers, you can be relatively flexible with those types of communications as an issuer. And I think that is a really strong litmus test for any company considering equity crowdfunding, where you can say, do I actually have the level of support in my personal networks, in my community, to raise capital? And you need to think about that really creatively, because the way that our industry approaches fundraising is so different from a traditional private Reg D capital raise, where you're only thinking about calling people, taking meetings with people who can write $25,000 checks or more. Whereas in our space, those efforts can be put behind a net that's cast much wider. And when you're thinking about investment, you need to broaden your horizons and say, I can now raise capital from someone in my community, in my network, in my customer base, who can invest $300, $500, $1,000. And I think that opens up a lot of opportunities for founders when they really take the time to consider what that actually means. So a big piece of advice is test the waters. Go out, see if your community is interested in even investing. You may be very pleasantly surprised by how engaged your network is, or actually wants to be, from an investment, from a shareholder perspective.
Test the waters, absolutely. I'm a big pre-launch fan, and if Test the Waters is the vehicle to get reservations and get a percentage of those reservation holders to participate day one, week one, that's going to set them up for a stronger foundation to hit their goals. I was mentioning those stats earlier, and if I look at all of the Reg CF campaigns to date on King's Crowd, if I remove the ones that haven't reported, and I know many of those didn't do well, 50% don't pass the 100K mark. I imagine the StartEngine averages and metrics are much higher today. But what I'm looking to stress there is, you want to pass 100K in the first few days, first month, max, in path to your goal of, I know many issuers go to the 1.235 million before taking additional steps and potentially extending from there. So, I know the reward crowdfunding world, Indiegogo, Kickstarter campaigns, which I've taken fundamentals from as a marketer. If you don't hit a third of your goal within 24 hours, large percentage chance it's not going to happen. 30-day rounds, much different, but there's something to be taken from there in terms of best practices. And like you said, Test the Waters wasn't always available. And now that it is, more issuers should be taking advantage of it, because it's an excellent approach towards pre-launch.
Absolutely. The other big test I would recommend is test paid advertising, because, as you know better than I do, I think paid ads work for a good portion of issuers. When you look at, and obviously different issuers will have different metrics and thresholds for what's a minimum return on ad spend I'd like to see for this to be worth it. But I think in general, we see that ad spend works for most issuers. And when it does work, it can significantly help with that top of funnel traffic you mentioned. When you assume sort of industry average conversion rates, you need to be consistently driving that top of funnel traffic to your page, to your website, in order to have the group to go out to with additional messaging and additional touch points to eventually convert them into investors down funnel. I think paid advertising is a lever that, at the very least, every issuer raising through Reg CF or Reg A should try. And there will be the rare cases where, for some reason, it's too convoluted of a message or it just won't work. But I think those are very much the edge cases. And for every issuer, at the very least, it makes sense to test and run a few weeks, spend a couple $100s a day to allow yourself to get the data to optimize. And generally, you'll see that's a very important lever to pull as part of these raises, unless, of course, you may be right a consumer facing brand that has hundreds of thousands of people you can go out to and largely fill up your round organically.
It's like you were mentioning earlier, many of these investors have not had the opportunity to participate in rounds for these verticals, for these companies in growth stages. You're talking about clean tech, drug discovery, various different platforms, and the advertisements are a perfect platform to really be able to speak to that organization, product, team in a visual manner. And top of the funnel, yes, getting the traffic there. Perhaps there's earned media, an existing audience, various types of strategic partners, maybe a financial email newsletter that can be promoting a deal. But advertisements can be run in-house. I've seen many groups do it in-house. I've seen agencies, quarterbacks, all different types of groups taken in to be able to prospect and then to be able to retarget. It's usually, if we're looking at digital best practices, 7 touch points or more before an audience converts. So,
Mm.
you could be intentional about what those audiences are seeing in the creatives to follow. And if you're hitting a good cost per acquisition, you could, of each investor, if you're hitting good return on ad spend, it's somewhat systematic to increase, how much traffic, how many investments are coming through. So we've seen it to be instrumental in our campaigns. I would really, mention that content marketing and other types of mid-funnel thought leadership can go a long way. So social media, email, long form content, including webinars, articles. I believe these pieces can be done internally by issuers. There are other groups that offer it, including us as well. But I try to make all recommendations actionable from listeners, viewers themselves. So I find it to be the combination. What do you do if a campaign's not working? If Test the Waters is live, it's not getting the reservations or signups that the founder, the team are playing for. Ads are not converting to the levels they need to be. What are the best steps to take at that point?
Sure. I think number one is a reevaluation of what kind of messaging are you putting out there. Is there something in the way you're presenting the company, the reasons to invest you're focusing on, right? Maybe it's the creative assets you're using. Is there something that doesn't work there? Anything that sort of stands out glaringly? This might be impacting your conversion rates. I think that's the first step is take a step back and just say, is there anything that feels just objectively sort of wrong here? Can we take a step back and say, does anything stand out and seem a little off? And a lot of times I've found with issuers, there's something, especially if they're not familiar with this space and they haven't raised capital from the general public in the past, because as you know, the type of messaging you go out with for an equity crowdfunding raise is very different than the type of messaging founders are typically used to going out with when they're pitching angel investment groups, they're pitching VCs. So you need to recraft how you present your company, I think, quite materially when you're going out and raising within an investment crowdfunding context. So the first step is really to, again, take a step back and ask yourselves, how are we presenting this? And is this appropriate for the audience we are asking for investment from?
And even looking to gauge, does something feel off? I think that's such a
Yeah.
great point. I point at audiences, messaging, the funnel, and being able to really hone in on the messaging and perhaps take some additional tests. A/B, the messaging on the updates, the ads, the email, any of the copy that's going out to see if you can produce a lift in the response.
Absolutely.
What about scale? What have the top issuers done to scale and hit the full cap on StartEngine? Uh, that has been, a commonality, a consistency to you. What would you recommend for issuers that, let's say, are mid six figures into the round right now, 500K raised, $800,000 raised? They're in path to 1.235 to 5 million, what have you. What has been most impactful towards scaling?
I think it goes back to testing. when you have that strong positive momentum behind your raise and you're crossing the 300K, 500K, 600K marks, continuing to test different channels, primary advertising channels, as we've spoken about, running paid advertising, thought leadership through content marketing, posting updates to your campaign page. For different campaigns, different levers, those ones that we've mentioned, will have different levels of impact. We have some campaigns where every time they post an update, they're raising thousands of dollars or even tens of thousands of dollars. So they'll really focus for a 3-week period on, we're going to post updates. We're going to really nurture this follower funnel. We have other companies who will explore what I call secondary channels and look for some paid newsletter placements, or write an article in a Business Insider or a TechCrunch, and that can be very successful. With others, they'll see success through paid advertising and continue to put more capital behind that and grow what their monthly ad spend, what their weekly ad spend looks like. More broadly speaking, from a strategy perspective, I've always been a big proponent of start off at that $1.235 million raise level with CPA reviewed financials, and use it similarly to testing the waters as a litmus test for your propensity to crowdfund. And we've found, as issuers are able to oversubscribe that first tranche of capital, the main reason being you don't have to pay for an audit when you raise up to that amount, you see an ability to really get the crowd excited and build an even greater funnel when maybe your invest button switches to a join the waitlist button. And the social proof that comes along with oversubscribing a tranche of capital, I think, gives you even more momentum going into a larger raise when you maybe amend from 1.2 million up to 5 million.
Absolutely. And want to echo that to the audience as well. Harrison, you've obviously worked on a lot of these campaigns. It's no wonder you guys are able to produce the results that are leading the space today. And I speak with prospective issuers across the board. Some of them haven't even completed their filing yet, that believe they're going to raise 5 million in a month, 2 months. They're focused on cost of capital, not whether the round will be successful or not. They're not looking at how many issuers actually do that. And to be able to go after that 1.235 first, really validate the vehicle for their own round, figure out the messaging, the audiences, the channels that are driving and physically producing results for them. Not just their assumptions, but the physical analytics data that are proving that it's working, and then go at higher levels from there. Harrison, it's very refreshing speaking with you and being able to talk about everything we see working in the space here today. If listeners, viewers want to continue this discussion firsthand, what's the best way for them to learn more about StartEngine, potentially get in contact with yourself? And what are some final thoughts you want to leave them with here today?
Absolutely. Pleasure speaking to you as well, Jason. Really appreciate the time. Appreciate you having me on. I know we share a lot of the same insights about the industry and sort of the trends we're seeing. Founders, anyone looking to learn more from a founder perspective, from an investor perspective, feel free to reach out to me on LinkedIn, or my email is harrison@startengine.com. And final thoughts, I think, is really, as we've sort of talked for the last hour or so, just to sum everything up, is, as you noted, there's still a lot of growing and I think learning to be done in this industry. And it's still a tricky way of raising capital. You and I will probably be the first people to say this is not easy. It's not a silver bullet to fundraising, but when done correctly with the appropriate expectations that are set, and issuers understand what it takes from a thought leadership perspective, from a content creation perspective, from a paid advertising perspective, we've seen this work incredibly well and allow companies to be very successful, raising tens of millions in capital. And there's a pretty tried and true, I think, formula to accomplishing that at this stage. And it's about continuing to double down on that template, that formula for success. And as the industry evolves and more people start investing through these funding portals and through broker dealers that are hosting these raises, and as I think we see from an investor standpoint as well, more diversification within portfolios, I think it only becomes easier for companies to raise and to use this regulation successfully.
Harrison, thank you so much for taking the time to hop on this podcast. Absolutely have shared viewpoints here, and glad that we're able to get this this content out to audiences. If you're not set up to raise, if you are and have not spoken to StartEngine, have not spoken to Harrison, I would definitely take that invitation to heart and reach out accordingly. Harrison, thanks again. It's been a pleasure to have you on the podcast today.
Thanks a lot, Jason. Really appreciate the time.
Thanks, everyone. We'll see you next time. Take care.